Hi, I'm Ashwani Patni. I head products and alternatives at Axis Asset Management Company. Let's see what these questions are. What is the difference between equity mutual funds and debt mutual funds? Debt is typically when you give debt to a company or an entity, it's a fixed tenure contract with an yield. The money is expected to be returned back to you with that defined yield. So therefore, it is meant as a more fixed tenure, defined yield, a more stable kind of a proposition. What about equity? When you give equity to a setup, typically that is much more of open-ended, longer commitment to that company. You are saying that you are willing to take a risk of that company going up and down, but your hope is that you will participate as the company progresses and does much better over a long period of time. Debt mutual funds, you look at those kind of investments which are much more stable, regular income, can work at different horizons. Equity mutual funds typically look for much more high growth, slightly higher risk kind of a profile, typically much more suitable for much longer horizon investors.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.